Welcome to episode 9 of the SaaS Report. I'm your host, Matt Aird, a founder and CEO at Sales Science. Today, we're going to be taking a look at Q2 results for Appian and Blackpearl Group, a New Zealand SaaS company. We're going to take a look at Q3 results for ServiceNow. So we're going to start to see Q3 results drip in over the next few weeks for the SaaS companies that we track. Then we're going to take a deep dive into the acquisition or the take private of Zuora by Silver Lake Group. We're going to dissect Atlassian's ACV growth over time. And then we're going to take a look at how much SaaS companies have to spend in order to generate $1 in net new ARR. But first, let's check out the news. So Appian's Q2 results are live. Appian is a low-code application builder. They sell to large enterprises to help them kind of manage workflows internally. They compete with companies like Pegasystems, OutSystems, UiPath, right? These kinds of organizations. And they've had a decent last 12 months from a growth standpoint. So they grew ARR 20% year over year from 375 million up to 451 million in Q2. Still running pretty heavy losses though. So generated a operating loss of $40 million for the quarter. Had negative $18 million in free cash flow. They have decent go-to-market efficiency, so they're spending about 45% of revenue on sales and marketing at the moment. They've got a CAC payback over the last 12 months of 32 months and a magic number of 0.5. Really strong NRR, that's at 118%, up from 115% in Q2 of last year. But pretty low ARR per employee, so they're just over 200,000 in ARR per employee, up from 162,000 this time last year. But they're not growing super fast for a company of their size. And the share price is basically sideways. So from the time they went public in 2019 to now, I think share price is down overall about 8%, but it's been a fairly average performance for Appian since going public. They're currently trading at just over 5 times ARR right now. Last week we got Q3 results for ServiceNow, so this will start to kick off our Q3 earnings season. And ServiceNow shareholders off the back of that earnings call are about $11 billion richer. So ServiceNow had a big revenue beat for the quarter. They had estimated around $2.74 billion in revenue for Q2. That actually came in at about $2.8 billion. And so the shares took a nice jump up about 6% off the back of that announcement. ARR increased 23% year over year, up to $10.86 billion. They added almost $700 million in net new ARR in the quarter. To put that in context, that's more than $10 million per business day in Q3. To grow at 23% when you're at a $10 billion run rate is pretty incredible, right? To put that in context, HubSpot is growing at about the same rate, but their ARR base is about a quarter the size of ServiceNow's. And if we go back in time, if we take a look at Salesforce in September of 2017, Salesforce were doing about 10 billion in revenue at that point. They were growing in the kind of mid-20s range as well. So ServiceNow is in this category that very few SaaS companies have ever been in, right? At 10 billion in ARR, still growing ARR, still growing revenue very strongly. Incredible performance from them at the moment. They've got CAC and magic number, both improved about 7% year over year. So CAC payback down about 7%, magic number up about 7%. CAC payback was down to 21 months. Magic number up to 0.71. They had 470 million in free cash flow for the quarter, 17% free cash flow margins, and a rule of X of 63, which is incredible. They're trading at about 18 times ARR right now. We also got a Q2 report out of Blackpearl. Now, Blackpearl is a New Zealand tech company. Blackpearl operates as a bit of a holding company, so they've got 3 products in market. 2 of them focused on kind of the email signature space. They've got a product called Blackpearl Mail, which they've developed internally, and then another email signature management tool called New Old Stamp. Now, from looking at this, it appears that New Old Stamp kind of acts as a bit of a freemium lead generator. They generate kind of traffic through that product and then look to upsell them into Blackpearl Mail. But the real momentum for this company has come over the last 19 months when they launched a product called Pearl Diver. Now, Pearl Diver, think of this as like a feature-rich version of B2B, right? So this is a tool that helps organizations to de-anonymize the traffic that's coming to their website, right? So you've got a bunch of traffic coming to your website every day. Most of the time, for most organizations, you don't know who those visits are from, right? You have a look at Google Analytics, your website traffic, and you can see the number of people turning up, but you're not sure who they are, right? What Pearl Diver does is it de-anonymizes a portion of that traffic so you can actually see who's visiting the site. Now, this is obviously very helpful for organizations as they look to figure out in a kind of like post-cookies kind of world, how do we figure out remarketing? How do we figure out, people that might be interested at the top of the funnel so that we can then begin to engage and nurture them through a buying journey? So that's what Pearl Diver does, right? Takes this traffic, de-anonymizes it, and tells you who's turning up on site. Now, this company, or from this product, they're at about 10.4 million in ARR right now. That's 22% growth. They reported 22% growth quarter over quarter, right? So from Q1 to Q2, they generated 22% growth. They're at 73% gross margins. And they also announced this quarter they just completed a $10 million capital raise and see a very clear line of sight from 10.4 million up to 20 million in ARR. Now, this is a category that's likely to become fairly competitive, right? As these tools become more important, as I mentioned before, as you've got the reduction in the ability for companies to be able to run retargeting through cookies due to privacy changes on platforms. You've got a bunch of players already kind of in this space. B2B, we mentioned before, pretty famous through LinkedIn. You've got Instantly that have a product here, Leadfeeder, Snitcher. All of these organizations have or are trying to create ways for organizations to figure out who's coming to their traffic so that we can retarget them. I don't think that there is a lot of differentiation in the way that these organizations do this from a product standpoint, right? I don't think technically this is super difficult, but I think there are two really important levers that will determine kind of who captures the majority of the market share here. The first one obviously is accuracy, right? You want to make sure that if you're getting an alert that, Joe Smith from a company that you really want to sell to is visiting your website, you want to make sure that it is actually Joe Smith that's turning up there, right? So accuracy is important. The second is kind of what you might call the reveal rate or the de-anonymization rate, which is, what portion of the site visitors can we actually map back to a profile and to a person that we have data and information on, right? Those two things are going to be really important. And then the third thing, or I think the area that organizations can carve out their own kind of niche or place in the market, is thinking about kind of the workflow and the segmentation that comes off the back of this de-anonymization, right? So you've got people coming to the site, you're able to identify who they are. You want to do that at a rate that's as high as possible, but then what do we do with that information once it's in place? And so that's thinking about things like, how do we segment the data? How do we allow companies to be able to set up segmentation around, ICP, whether that's, tiering leads or contacts into, these are people I want to deal with in this way, these are people I want to deal with in this way, and having the tool be able to make those decisions in the platform before the leads are routed in a certain way. And then also, does it give us any ability to be able to do something with that data once we've de-anonymized it and once we've segmented it? Because if you think about these tools, if you've got a site that has very high traffic flows, these kinds of tools can create a lot of noise if the segmentation and the prioritization and the workflows isn't built in correctly, right? You just get a ton of data around, all of these people visiting the site, most of which is probably going to be irrelevant for what you're trying to achieve as an organization. Now, the reason that thinking through these niches or the segmentation or how the product is used is important is that at the moment, it looks like a fairly high churn category, right? So our B2B report about 10% monthly churn, and Blackpearl have identified that their churn is about 4% a month. And so that's fairly high, right, in B2B SaaS. And so these organizations are going to need to think about how they make changes to the product and the customers that they're targeting in order to improve those over time. And I think, there's some real opportunities here for organizations to be able to differentiate themselves here, right? Whether that's, building a product that's specific for, sales-led motions into very high ACV segments, right? Or whether that's building products that are more kind of targeted towards remarketing, content redistribution, targeting more through, ad networks, that kind of thing, at, kind of a lower ACV product that needs to be kind of more self-serve or product-led. All of these organizations or all of the players in this space kind of operate in a similar way. It's still a fairly immature market, but it'll be fun to keep track of this and see how the space develops over the next few years. So we all know Atlassian is an incredible business. I think one of the reasons that they've been able to generate such strong growth rates and strong go-to-market efficiency is because of this ability that they have to increase ACVs over time. Right now, to provide a bit of background information here, let's look at Atlassian's growth rates from 2017 through to 2023. So 2017, they grew ARR 73%. 2018, 56%. 2019, 50%, 2020, 36%, 2021, 64%, 2022, 40%, and in 2023, they grew at 31%, right? So that's ARR growth all the way from 200 odd million up to 4.3 billion that they're at today. And they've done that in a way that's extremely efficient from a go-to-market standpoint, right? So if we look at CAC payback as a proxy for how efficient they are from a go-to-market perspective, and we look at this from 2017 through to 2023, we can see that CAC payback was 9, then 8.5, then 9.3, then 11.6, 5.3, 12.2, and then 15.4 months. Right? So to put that into context, if we look at other organizations like HubSpot, they've got CAC payback of 33 months. Monday's at 27 months, CrowdStrike's at 21, and Smartsheet's at 41. Right? So growing ARR in kind of like top tier growth rates at a go-to-market efficiency over the last 7 or 8 years that is completely unmatched, right? And as I said, I think one of the key reasons for this is that they've been able to grow ACV so strongly year over year. So in 2015, Atlassian had an ACV of just under $2,500, right? So an average customer paid them about $2,500 per year. Fast forward to 2023, and that was almost $12,500. So that's a compounded annual growth rate of 21% per year. To contrast this, you've got, if you take a company like HubSpot, they've basically seen no change in ACV over the same time period. So in 2015, ACV for HubSpot was around $10,000, and in 2024, still to today, it's around $10,000, right? So basically no change. If you look at another company, Procore, they've done a pretty good job of growing ACV. So they've gone from 36K to 67K, but that's at a CAGR of only 11% versus the 21% that we see for Atlassian. Now, what this does is it just makes the business more efficient to run, right? If you're able to bring a customer in and then increase the amount of stuff that you sell to them over time, and then every single year get new customers that pay you more as well, you're able to drive up this ACV, which helps with sales efficiency and helps with growth rates. Now, I think one of the reasons that they've been able to do this so well is that they're really a multi-product company right now, right? So you've got Jira, which is the kind of workflow management tool. You've got Confluence, which is knowledge management. You've got Trello, which is kind of in the workflow management space as well. You've got Loom, which they've just acquired, which is kind of in the productivity type solutions around asynchronous video communication, right? And so you've got a bunch of different entry points into the Atlassian ecosystem, which they can then use to cross-sell or upsell these larger organizations that come into their ecosystem. And they've done that exceptionally well. So they report having about 80% of the Fortune 500 as customers right now, right? And then obviously they've got a really long tail of self-service customers that are buying 1 or 2 Trello seats or a handful of Jira seats, whatever it might be. So yeah, Atlassian is firing on all cylinders right now. They're trading at 11 times ARR and are forecasting to be at about $10 billion in ARR by 2030, right? So well on the way to that. And this, I think, is no small part of that, right? By being able to increase the amount that every customer pays them on average year after year is a big driver in helping them to continue those growth rates in a way that's efficient from a go-to-market standpoint. All right, a lot of you will be doing budgeting and planning for 2025 over the coming weeks and months, and probably projecting, right, what are we going to hit in terms of net new ARR, right? If you're a SaaS business, ARR growth is still the headline metric, and it is what are we going to get it to from now to the end of next year. Now, one of the ways that you can think about this is, you're obviously going to be creating a budget alongside that, and you need to figure out how much are you going to spend on sales and marketing in order to drive that ARR growth, right? So hopefully what you're doing is looking historically at the numbers that you've generated. So if you take a look historically at the amount that you've had to spend on sales and marketing in order to generate net new ARR, and you're not making a jump or a leap that's too deviated from those historical returns, right? So for example, if previously you've had to spend $2 to generate $1 in ARR, I hope you're not projecting that you'll be able to generate $1 in ARR for 75 cents in sales and marketing spend this year, right? You want to sense check that. You want to make sure that the targets that you're setting are realistic based on past performance, because otherwise go-to-market leadership is going to be disincentivized, right? Sales team is going to be disincentivized, quotas are going to be harder to hit, and the story that you tell your board or your investors may not actually be achievable based on what the business has done historically. So I can't review your numbers for you, but what we can do is have a look at these public SaaS companies to give you a feel for the numbers that they've been able to hit. And so what I did was I had a look at a handful of companies from the 30 odd that we track and took a look at for Q2 of this year, how much did they have to spend on sales and marketing in order to generate one net new dollar in ARR. And here are the results. So Palantir was the clear leader here for Q2. They spent $1.10 on sales and marketing for every dollar in net new ARR that they generated. Worst performer was Salesforce. They had to spend $4.50 on sales and marketing to generate one net new dollar in ARR. Only 8 of the companies were able to spend less than $2 on sales and marketing to generate that $1 in ARR. Right, and those were, we had Confluent, ServiceNow, Zscaler, GitLab, and Monday.com. They were at $1.71. UiPath, Box, Sprout Social, and Salesforce were all over the $4 mark. The median came in at $2.22, and the mean came in at $2.59. Now, if you're an early stage SaaS company and you're at or around about $1 million in ARR, your numbers are probably going to look a lot different to this, right? You're probably not, well, I hope not anyway, going to be coming in around the $4 mark, because you're not going to be in business for much longer if that's the case. So they're likely to be lower. But again, I think the lesson here is that you need to take a look to make sure that the amount that you're allocating to generating net new ARR gives you a realistic chance of hitting your ARR growth goals based on the historical performance of your business. So final segment for today, we had news last week that Zuora is going to be taken private in a deal worth $1.7 billion. That take private has been led by Silver Lake. That prices Zuora at about 4 times ARR, or about an 18% premium to the share price before the news was announced. This is, as you remember, the kind of second take private that we've seen over the last few weeks. So a couple of weeks ago, we had reported news that Smartsheet was being acquired by Vista Equity Partners. Coincidentally, last week we reviewed Zuora's Q2 numbers, and they weren't great. They grew ARR just 7% year over year. Their ARR was just over $412 million. They added $8 million in net new ARR in Q2, spending $36 million on sales and marketing in order to do that. That gave them a magic number of 0.23, CAC payback of about 60 months. They're decent NRR, so positive NRR, 104%, 7% free cash flow margins, but fairly average performance from these guys over the last few years, and that has resulted in this acquisition price being about 50% lower than the peak valuation that they achieved in 2021. And also a pretty small premium over the current price, right? So if we compare this to the premium that Smartsheet generated, so Smartsheet generated a 41% premium through the acquisition. So basically what that means is the acquisition price, or the price for the total deal to take Smartsheet private, was 41% higher than the price that the shares were trading for the day before the news was announced, right? So the acquirer has said, look, we want to get this deal done. In order to do that, we need to make it attractive to shareholders. We're going to have to pay a premium on what the company is currently valued at. And that premium they paid was 41%. If we look at the Zuora deal, the premium that they paid was only 18%, right? Which suggests that Zuora had a lot less power in this negotiation. right? And we can probably see why that's the case. It appears that this process for take private was actually initiated by Zuora. Jason Pressman, a member of Zuora's board of directors, said that our agreement with Silver Lake and GIC represents the culmination of a comprehensive process to determine the best path to maximizing value for shareholders. So it sounds like they had made the decision internally that they were going to look for a take private opportunity and found a bidder here in Silver Lake, but probably didn't find anyone else that was that interested, right? If they were only able to achieve an 18% premium, it tells me that there wasn't a lot of kind of competitive bidding for Zuora this time around. Now, Zuora, I think, plays in a fairly interesting space, and a space that's evolving pretty rapidly, right? So we've got this kind of monumental shift that's happening in SaaS and technology at the moment, and this is this shift more so away from kind of typical reoccurring subscription payments towards more of a consumption-based or outcome-based pricing model, right? So if you think of the rise of AI and the increase of kind of like this concept of agents, we're going to see more and more companies charging based on what they actually deliver for you or what data or services you consume from them directly, as opposed to just coming up with a monthly subscription amount that you pay and you get access to the full platform. And we can certainly see this shift because, Salesforce announced that they'll be delivering consumption-based pricing to their users moving forward as well. And so Zuora's historically come up in the space of helping organizations to manage subscription payments, right? So they came to market at a time where a lot of the payments were kind of, more traditional and transactional. They helped organizations to implement subscription-based pricing and have now moved into the world of kind of this consumption or usage-based pricing. But that is, I think, going to even just become more important over the next few years as we continue to see this shift and this adoption of kind of like AI products more so over the next few quarters. So it'll be an interesting market to watch. Pretty competitive space, right? There are a bunch of competitors that play in the same market as Zuora. So it'll be interesting to see what Silver Lake does. But they've obviously got a bunch of experience in this area. They've got investments in companies like Airtable, Clary, Carta, Salonis, Qualtrics, right? So really established player in the enterprise software space. And interestingly, they're also the company that owns the UFC and the WWE as well. So they purchased Endeavor, or they took Endeavor private, which is a publicly traded company earlier this year as well. So I kind of like this play for Silver Lake. I think they got Zuora fairly cheaply, right? If you can buy a SaaS company outright for like 4 times revenue, they're cash flow positive. They've got positive net revenue retention. I kind of like this for Silver Lake. I think they got it pretty cheaply. So it'll be interesting to see how this goes over the next few years. All right, that's it for this week. Thanks for tuning in. As always, if you have any feedback, if you have any questions, if you have any comments, let me know. I want to make this as interesting and informative for you as possible. I will see you next week. Until then, goodbye.